Zarina, can you see the screen? हेलो, बोलो बाबा, आप लोग को स्क्रीन दिख रहा है क्या?
हाँ सर।
अच्छा, जरीना आपका आवाज ही नहीं आता है मुझे. हेलो, जरीना, आर यू फॉलोइंग?
My screen is blank.
Sorry,
Your screen is black. I am not able to view your screen.
you're not able to see
No.
now?
Still not able to see, sir. I think after
Not
some
yet.
time it might come. I have internet issues.
Yeah, again you can just come online.
I tried doing that, sir.
Yeah, okay, you can rejoin, no problem. But what about Zarina? She's not answering. Zarina, आप एक्टिव हैं? अच्छा, क्योंकि आपका वॉइस ही नहीं आ रहा. ओके फाइन, ओके, या okay, let's like continue. So I was saying about the straight line method. When you use for tax purposes, the depreciable base is always 100% of assets cost. Okay, now the US Internal Revenue Service generally requires assets depreciated on the straight line basis on the tax return to be depreciated monthly. So they want monthly depreciation to happen here. That is what they generally require. So now don't worry about this. Let us move forward and see what the textbook says. If an exam question specifies that a company uses straight line depreciation for tax purpose, it will usually state that asset was purchased on either January 1st or on June 30 or July 1st, that is mid of the year. Okay, next. Now, if the asset was purchased on January 1st, so what you need to do? You need to take full year of depreciation in the year acquired. That means when you acquired the asset on Jan 1st and December 31st happens to be the end of the year, you should take full year depreciation. Okay, so uh, so now please understand, a 3-year asset will be depreciated over only 3 tax years, not 4 tax years. So this is a most important point you should understand. This is not like the MACRS method whereby half year convention runs, half year in the first, half year in the last, and full year in the between years. Here, if there is a straight line method and the asset has been purchased at the beginning of the year, full year depreciation you need to take, and if it is a asset which has to be depreciated for 3 years, they would not spread the depreciation for 4 years. It would only be for 3 years. Okay, but now point number 2, if the asset was purchased on June 30 or July 1st, take 1/2 year of the annual straight line depreciation amount in the year acquired and leave 1/2 year of depreciation for the final year. So a 3-year asset will be depreciated over 4 tax years. So if it's in the mid of the year, so half year in the first year, half year in the last year, full in the between. So 3 years asset will be depreciated for 4 years. Okay. Now, one more last point. If the asset was purchased on any date other than Jan 1st, June 30 or July 1st, calculate the monthly straight line depreciation for first year and the final year of the asset's life as needed. Okay. The asset will be depreciated over one tax year more than its life. For example, please understand. For example, a 3-year asset was purchased on October 1st. So it will be depreciated for 3 months in the first year and rest of the 9 months in the last year. So suppose October is what you have purchased the asset. So October, November, December, 3 years in the first year, in between 2 years, full year, and the last year, 9 months, 3 months, first year, last year, 9 months. Then here, full year. Okay, so that's fine. Now there's a question asked here, which method of depreciation is best? The depreciation method a company should use is one that best matches the recognized depreciation charge with revenue management. expects to receive from the asset. Yes. See, yesterday I have explained you, if you are using a asset for personal use, so what is more justified? Straight line method. If you are using an asset for taxi purpose, what is more better? Double declining method or sum of the years digit method. So it depends upon the usage of the asset and what the management thinks is the best method they have to apply for that asset. Okay, asset depreciation. So now the method of depreciation should not be selected on the basis of which method it will result in a desired net income amount. Considerations for which depreciation method should be used include. So what is the consideration you have to take when you select or pick a method of depreciation? Three considerations they are giving. Let's understand. If the revenues management expects to receive from the use of asset will be, so see, please understand, if the revenue management or the department which is dealing with this revenue center, let's say revenue center or revenue department or finance department, anything, accounting, if they expect to receive from the use of asset, okay, they are expecting to receive from the use of asset some constant like performance, okay, some constant revenue every year. So straight line method would be a better one for that. To match with that revenue, this depreciation would be the ideal one. That is what they're saying. Okay, so if the revenue management expects to receive from the use of asset will be constant over its useful life, straight line method should be used so that the costs are also constant over the asset's life. So when you have constant revenue, that means constantly you are earning revenue. I'm not saying constant revenue here means fixed revenue. uh, that is also a probability. If you have fixed revenue or if you are constantly earning revenue, straight line method is a good one to match as per the matching concept. In contrast, if revenues from the use of asset will be higher at the beginning of the asset's life, as I said you, beginning of the asset's life, then accelerated depreciation method, because during the early years your asset would be you'll be using the asset to the maximum use. Okay, you'll be using it maximum during the early years. So double declining method or accelerated method would be a better option rather than straight line method. Okay, so if an accelerated method of depreciation is used, depreciation recorded will be higher and the net income and net assets will be lower in the early years. Yes, for example, if I take straight line and double declining method, so here 10,000 is my depreciation, here my depreciation will be 20,000. So here my income will be less during the early years. Okay, here my income would be high, because higher the depreciation amount, it lowers the income. Lower the depreciation amount, it enhances the income, and vice versa. So like then they would be if straight line method would be used. Now if the revenues from the asset will be lower at the beginning of the asset's life, so in the beginning years the revenue is less, the amount of depreciation recorded in the earlier years would be lower than the amount recorded in later years. Lower depreciation in the beginning of the asset's life can usually be achieved through the units of production method. Why? Because during the earlier stages the machine would be, you would be using the machine or the production based upon the orders what you get. Am I right? Please tell me yes or no. Do you think when you start a business activity immediately you are going to get very high orders? No, less orders.
No.
So in the beginning you would be using your asset, you will be using your asset, but the usage would be less in the
Yes.
earlier years, and as the time passes your business is established properly in the market. So with 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 its since it is an established business, they get more orders and they produce more, so then the depreciation would be high in the coming years, in the later years. So in the beginning years the depreciation would be less, and the later years depreciation would be high. Okay, so when depreciation is less in the beginning years, your income would be more, and here in the later years your income will be less. And what is the method we are using for that? Units of production method. That means based upon the number of units what you're producing, your asset would be, or your machine would be depreciated. Okay. Now, I'm coming into the next topic, which is impairment of long-lived assets to be held and used. That means you want to use it for a longer period of time. Now, what do you mean by impairment? This term called impairment. We are about to end the chapter now. What is impairment? See, impairment, if you see in English dictionary, impairment means some kind of damage. So there is Mr. X, and he's riding a bike, and he happens to accidentally hit some pole or something, and he meets with an accident there, and one of his bones is fractured. Okay, so now he has what? Impaired bone. What is this impaired bone? Now Mr. X would not be able to walk that efficiently, which in the normal circumstances, without this particular event would have happened. Okay, he was very normal. Okay, so now it is not a normal condition for him, it's an abnormal condition for him. Correct? Yes or no? Do you think he can with impaired bone, he can have the similar kind of experience while walking, which he used to have when he was not having impaired bone? Or do you think now he is more efficiently walking than before? No. Correct, because of the impaired bone. Or we can take one more example. You have just bought a phone, iPhone or Samsung phone, whatever it is, and you just bought it from the showroom. After 15 days, after 15 days, while climbing the staircase, accident, like what happened is, you accidentally happened to hit something, or like this particular mobile phone slipped from your hands and it fell down, and it kind of hit the surface, and the screen of this phone, now it has a broken screen. Correct? Correct. So what, this phone is nothing but an impaired phone now. Do you think you are going to get the similar kind of experience while watching videos, or while watching any kind of any photo or image on this phone as you were experiencing before? Please say me yes or no. Are you going to experience the similar, the same kind of, are you going to get the same kind of effect or same kind of performance from this phone which it used to give before it fell down? The performance of the phone has got deteriorated now, because of what? Because of this, it getting damaged. I don't know why you people are not speaking out. Yes or no? Nahi bol rahe.
Yes,
Yes.
sir. Yes, sir.
Hello.
Just give me 1 second. Hello? Hello?
Yeah, so do you think this phone is going to give you that performance? No. Now the performance of the phone is not up to the mark because of the impairment, because of the damage which has happened to this phone. Now, this phone you bought for 20,000, let's say 20,000, and you went to the market, and now you want to sell it. So the buyers, the buyers, or to whomever you are ready to sell this phone, are offering you 5,000. So now 20,000's phone, the phone which you bought for 20,000, you are forced to sell at 5,000. So there is a loss of how much? 15,000. So this 15,000 is nothing but impairment loss. Okay. So this 15,000 is impairment loss. I would write some point here. Now, there are two school of thought, IFRS and US GAAP. They have a different kind of treatment for impairment loss. Okay, what IFRS says is when the carrying amount is more than a recoverable amount, okay, then there is a impairment loss. So here carrying amount is nothing but book value. Recoverable amount, I'm using easy terminology for you. They don't use book value and market value in IFRS. I'm using it for your sake. This is book value, carrying amount is book value, and recoverable amount is market value. For example, just example, there is a different definition of recoverable amount. There's a different definition of recoverable amount. Now today, after taking the class, if you search somewhere, some sources, you would be getting a different answer. I'm not going into details of IFRS because it is not there in your syllabus. I always take IFRS sessions, classes, so I know better, but I want to make things easy for you to understand. So when your carrying amount is more than recoverable amount is nothing but you are showing the value of asset in your books as 1 lakh, in the balance sheet as 1 lakh, and when you are ready to sell that asset, you are only getting 70,000 in the market. So the phone which is in actuality of 70,000 you are showing as 1 lakh in your books. So there is a loss of how much? 30,000. Okay, you are showing the value, you are showing a higher value in your books, but in reality you are getting a lesser value for that. Please tell me, people, did you understand?
Hello? Hello? Yes,
Did you
sir.
understand?
Yes, sir.
You are showing a higher value in the books, but in actuality the value is 70,000. So there is an impairment loss of 30,000, correct? And this impairment loss should be shown in the P&L account or in the statement of profit or loss as a expense. Okay, now, but the case is different in US GAAP. US GAAP has a different treatment for impairment loss. Let's understand what is the treatment under US GAAP. Okay, just see the screen. See, under US GAAP, the most important source is ASC 36010. That is a standard actually, which regulates impairment of tangible asset. Okay. So how will you find out the impairment loss of a tangible asset under US GAAP? It's a two-step process. The two steps what you need to follow is US GAAP has a two-step test to determine if the asset is impaired or not. The first test is the recoverability test. So I will write it here. US GAAP has a two-step process to find out the impairment loss. First is recoverability test, and I'll also give you an example to understand this in a better way. So the first step is defined as recoverability test. Now, if the asset passes this recoverability test, okay, if the asset passes the recoverability test, then you need to go for the second test. If the asset is not passing the recoverability test, okay, then like you should not go for the second step. Okay, so we will see what is this recoverability step. Okay, I mean to say, I'm sorry if I have, like, I'll just change my words once again. The step one is recoverability test. That means if you are not able to recover the assets value, if you are not able to recover the assets value, then definitely the asset is not passing the recoverability test. That means it is failing the recoverability test. Suppose the asset is of 1 lakh and you want to recover this 1 lakh of asset from the usage of this asset. Please understand my words. The asset or the machine or something which you have bought for 1 lakh. This particular 1 lakh which you have invested in the asset, you are using this asset for some purpose in your business. Let's say you are using it for production purpose. So whatever the goods or number of units of goods, whatever you are producing, you will sell in the market and you will generate revenue out of it or cash flows out of it. So whatever you are generating the cash flows out of it, those cash flows should either surpass 1 lakh. Then we can say that we have recovered the value of the asset. If the cash flows what you are receiving in the future years from the usage of asset, that means the production what you're doing from this asset and the goods which you are selling in the market, you are recovering cash flows from the sale of those goods. And when you add up all those cash flows, you're not able to even recover the assets value 1 lakh, then you fail the recoverability test. Okay. When you fail the recoverability test, that means you are not able to recover the assets value, then surely that's an indication that there's an impairment loss. And then you need to go for the next test of calculating the impairment loss. Okay. So let's discuss this in the particular screen. Just listen here. The first test is defined as recoverability test, in which the book value of asset is tested. The book value of asset is not recoverable when it is higher than undiscounted cash flows expected from continuous use of asset. As I said, you will be using, see, 1 lakh is what you have invested in a machinery. You will be using this machinery for production purpose. Whatever the goods you are producing, you will be selling in the market and generating some cash flows. So those cash flows, when you add up, and like whatever the sum of those cash flows is not more than 1 lakh, it is less than 1 lakh, then you are not able to recover this 1 lakh. Hence, it's an indication that the asset has got impaired because you're not able to recover the value of that asset. Hence, you have to go for calculation of impairment loss in the next step. Okay. So I'll explain you one example here. Just you please follow this example. Okay. I'm writing a question here. Follow this up. Just a second. All of you, both of you should do this question in your books. Okay. Yeah, here. Okay, let's do the question here. So the question is example. So let's say there is a sewing machine. And the cost of that sewing machine is nothing but, and this is a new sewing machine, for example, and its cost is nothing but $20,000. Okay. And it is useful for 3 years and has a new book value of, suppose this new machine you bought for $20,000 and its useful life is 3 years. Okay. This particular sewing machine has got damaged. Of course, without damage, there is no impairment. And the new book value is $10,000. So if we see the IFRS, we were showing it for 20,000. Now its value is 10,000. So there's an impairment loss, okay, of 10,000, but not in US GAAP. In case of US GAAP, first we have to do the recoverability test. Now, what is that recoverability test? For that, you need to see the data in the question, whether they have given you undiscounted cash flows or not. See, listen here. The book value of the asset is not recoverable when it is higher than the undiscounted cash flows expected from the continuous usage of asset. So don't worry, I will write those things here. You can easily follow. So this is what is the new book value. Okay, new, not net book value, new book value. Now one more data is given, expected undiscounted. This is not discounted, it is undiscounted. That means I'm not doing any present value or anything. I'm just seeing what this sewing machine has contributed towards cash flow generation in my business. That means during its lifetime, how much cash it has generated. I'm not concerned with present value or something like that. I'm just saying how much I got every year from this machine, from the usage of this machine, which I've used for my sewing purpose. Okay. So expected undiscounted cash flows generated by the machine after the damage are. So as you know, the machine has got damaged, it seems, in between, and the new book value what you're getting is $10,000, and after the damage we got some cash flows from that asset. Okay, so US dollar 2000 in year 1 I've got, and then 2000 same in year 2 I've got, then 2000 same in year 3 I have got. Okay, now tell me how much is the sum total of this undiscounted cash flows. Yes, please tell me how much is the total of undiscounted cash flows. 6000, correct? And what is the new book value? 10,000. Are you able to recover your asset value? Please tell me. So 6,000 is less than 10,000. 6,000 is less than 10,000. Okay, fine. So we are not able to recover the assets value. So the recoverability test is failed actually. That means we are not able to recover the assets value. How we came to know that we are not able to recover the assets value? By adding this all undiscounted cash flows. So the sum or total of undiscounted cash flows is 6,000 and the new book value is 10,000 after the damage, and we are not able to recover this 10,000 even. Okay, so the first test, the recoverability test, is what we are not able to recover, and this has failed. So now we understood that the impairment has happened, it seems. We'll go for the impairment loss calculation in step number 2. Okay, so now impairment loss calculation. So now how much was my assets value in the previous the data what I've given to you? What was my assets actual value? 20,000. And how much after damage it has become? 10,000. That is what I'm getting. Okay, so how much is the loss? 10,000. What is this? Impairment loss. Okay, just make a note of this. Okay. Are you doing this? Smriti? Zarina, are you doing this? Hello? Hello? I'm not able to hear your voice, Zarina. Hello? So this is what we have done now, the recoverability test. So we have a question now. Why don't we solve that and just see the accounting entries. So that's what they're saying. Carrying amount is greater than undiscounted cash flows. That means you have not recovered this carrying amount with this. So there's an impairment. Okay, then we can calculate the impairment loss as I've explained you. So what is the formula for impairment loss? Impairment loss to accumulated depreciation. That means you can like directly transfer this to P&L account also, or like you can transfer to this depreciation account also. Okay. So let's discuss this question. Can you do this question and tell me what the answers, Zarina? Yes. Okay. Yes, Zarina. And then I have to discuss some more 2 points about this. Please carry on. Okay. You are done. Okay, let's do this. In Joanne Company's review of long-lived assets to be held and used, an asset with a cost of 10,000 and accumulated depreciation of 5,500 was determined to have a fair value of 35. So like 10,000 your asset was this and accumulated depreciation 55 and the fair value. So it's like, and the fair value you're getting is this. Okay. So we easily understand that the value has gone down, but we cannot directly say that value has gone down. We have to find out the impairment loss. For that, there are two tests. First is recoverability test, and second is, what is the second one? The calculation of impairment loss. So now your asset, like the net book, the new book value is 5,500, correct? This is the new book value. And the undiscounted future cash flow is 5,000. Are you able to recover the book value? No. So there's an impairment loss of 1,000. 4,5 and 3,5 deducted 1,000. Okay, let's check this. And in the second case, yeah, you're not able to recover in case 1 and you're not able to recover in case 2 also. Same impairment loss. 28. Okay, so the same thing is happening. Where is that? We got 1,000. So the future cash flows are 5,000 greater than the book value. What book value? They gave a fair value. What is the page number? $10,000. Okay, this is the book value. Okay, fine. So the first case was, I'm extremely sorry, this is depreciation actually. This is the book value. I'm just correcting it. I'm writing it here neatly. So 10,000 is your asset, 5,500 is your accumulated depreciation. Your new book value is 4,500. Okay, and it has become 3,500 it seems. So before saying that there is an impairment loss, we have to first go with the step 1, that is recoverability test. So under recoverability test, we'll take the new book value and we'll compare with the undiscounted cash flow. And really here we have recovered the book value. So our undiscounted cash flow is this, which is more than this. So the recoverability has happened. So no impairment loss. My mistake was I took this accumulated depreciation here. I'm sorry. Just when we write on the screen and do take online class, at times it's very hard to concentrate on the letters. The letters, they look very nearby and we tend to do some mistake. So like here what happens? Yeah, so this is the new book value and this is the undiscounted cash flow, and we can see clearly that we have recovered this. So no impairment loss, and we need not go for step 2. Okay, so 0 impairment loss. Point number 2 is our book value happens to be 4,500 and the like 3,000 is what we got undiscounted cash flows. So what like here did we recover 4,500? Please tell me, Zarina. Yes, we recovered. Am I right? Since we recovered this, there was no impairment loss. Okay. But did we recover in the case number 2? No. No recovery from the undiscounted cash flow. So we failed to recover the new book value or the carrying amount, whatever you want, you can say. And hence, since we cannot recover this, there is an impairment loss. We'll go for the impairment loss calculation, and that would be 4,500 it has become 3,500 now, the fair market value. So 1,000 is the loss, impairment loss to be written in the P&L. Okay, done. Now more 2 points I need to discuss about this. The points are, under IFRS, since we have seen the impairment loss, correct? Some asset which was of 10,000 has become 8,000 and there's a 2,000 impairment loss. Do you like, is it necessary that it can go less? It can go, there can be a higher valuation for this also, depending upon the demand of the asset, correct? Some assets like land, building, based on the demand of that building or land in some particular area, because of non-availability or less supply of land, we see higher demand of that land and the value goes up. So downward revaluation, whenever we do a revaluation of asset, we sometimes call some valuers who are experts in valuing an asset and telling us the value of that particular asset. So what happens if a valuer like to whom we have called, he sees that the asset had a value of 10,000 and now it is having a value of 8,000. He says that there is a downward revaluation of asset or there is an impairment loss. Both are same. But if it has gone to 12,000, there is an upward revaluation or revaluation surplus or revaluation gain. In that case, we would record the 2,000 revaluation surplus or gain in OCI, other comprehensive income. I am extremely sorry I did not take that chapter, first chapter completely, and hence you would not know what is this OCI section. So tomorrow, the next class when I'll be taking, I'll be finishing the chapter number 1 and then I'll be going for intangible asset. Okay, so I'll be explaining you what this OCI is, but for time being, you understand OCI is not a part of your profit or loss account. It's a separate account prepared after preparing the profit or loss account. So we say SOPL, that is the statement of profit or loss. But these days we are not preparing SOPL, we are preparing SOPL and OCI. That means statement of profit or loss and other comprehensive income. I will explain you that in the next class. For time being, you can understand that in IFRS, upward revaluation is also allowed. Okay, but in case of US GAAP, only downward revaluation is allowed. That means only impairment loss you can show, but no revaluation gain or surplus is allowed. Okay, why it is not allowed? They have a different thought process. They say you can inflate any value and you can write it in your books, so we don't allow it, but no one would hide a loss. Okay, because when something is really something which you are using for a very long period of time, okay, and there is with continuous usage of that asset, it is expected that it will lose its efficiency and we could expect loss, but we cannot say that it will improve its efficiency. So they are against it. Yes, they are against it. Yeah, they are against it. They really say that the efficiency cannot improve. So that's the reason why they are against revaluation gain. They are in favor of showing downward revaluation, that is impairment loss. Okay, so no concept of revaluation gain in any kind of in any ways under US GAAP. Okay, so that is the conclusion of the topic, because in this box they have explained such things. So under IFRS, but since our topic is not dealt with IFRS, or we are not dealing with IFRS anyways, we would not pay that much of heed or importance to this. Okay, if you are really interested in knowing about IFRS treatment, I have videos of the chapter called Property, Plant and Equipment explained thoroughly in IFRS. I give IFRS training also, diploma in IFRS. So I have a complete video of all this revaluation gain and all this treatment. If you are interested, I can send it to you. You can watch it. Okay, Zarina? But for the time being, under CMA, we don't need to learn this. Only downward revaluation or impairment loss is recognized. That's it. Okay, and that too, it is to be shown in the statement of profit or loss as a loss, as expense. That's it. So we have completed this chapter. Next chapter we will do the first chapter, whereby we would finish the leftover part. That's a 20-minute session, and we'll immediately jump to intangible assets. So this would be done by Monday. This is done. Cash is done. Cash flow statements. Receivable I have already given, done. PP is done now. Next, intangible assets and inventory. That is my target. Okay. Okay, Zalma. Thank you so much.